Increased his stake and reignited proxy fight concerns. Peltz's firm, Tryon Fund Management, is now one of Disney's largest investors, holding 30 million some shares valued at roughly $2.5 billion. Now, Peltz has been critical of the company's management as Disney stock sits near a 9-year low. And shares, by the way, are down nearly 25% since Peltz's first battle for a board seat back in February. But our next guest says it's the only credible challenger to Netflix in the space and sees an upside of more than 25%. Joining me now for more is Laurent Yoon. He covers media and telecom at Bernstein and recently initiated Disney with an outperform rating. Laurent, thank you very much for being with us here. Maybe it's not so difficult to put a buy rating on a stock that's lost a quarter of its value since the recent highs. That I can understand. But take us through why you think Disney has a real competitive advantage and a fundamental reason why it should be worth more in the future.
Well, first of all, thank you, Don, for having me. You're a huge fan of CNBC and really grateful to be here. Well, there are three reasons why we think Disney is a pretty attractive investment to go through at the moment. So the first one is the overhang that we have on linear is something that the market already expands quite well and should be digested. So yes, the linear decline continues, but it's something that we understand quite well. More importantly, we think that DTC growth and what that would look like with Hulu is likely to be quite optimistic going forward. We expect the DTC to outgrow linear by 2024. And there is a continuing growth prospect, especially in not only the U.S., but also in the international market. So that's our second view. More in the short term, there is a overhang on the stock because of what may happen between Comcast and Hulu in terms of how much Disney will have to pay Comcast for the remaining one-third stake that Comcast owns of Hulu. And we believe that number is something that is more reasonable. And once that overhang is lifted, we believe it'll serve as a positive catalyst for the stock.
Laurent, there's been a lot made of the streaming business trajectory versus those for the parks and recreation side of things at Disney. We know that Disney's made a very high-profile announcement about trying to pour $60-some billion into that parks business over the course of the next decade. Is the growth story that's going to propel the stock price more about the streaming economics or more about its traditional parks business?
I think it's both, actually. So the parks business obviously is a very important component of Disney. You can't really have Disney without the parks component. Today, it contributes over 70% of the firm's EBITDA today. The $60 billion number seems a bit scary, but if you project out how parks will grow into the next 10 years, the $60 billion capex actually is somewhat in line with how much they're investing in capex today in terms of as percent of revenue. So, of course, if you expect the parks business to grow, we would only expect the capex to grow accordingly. Supporting and of course all the revenue and the EBITDA coming from the parks business supports the media business that is turning the corner, and we believe that DTC Disney Plus combined with Hulu going forward is going to outgrow the linear decline that we've been seeing the past couple few years.
Laurent, before we let you go, one final question with regard to streaming, the economics. We've talked a lot about the writers' strike, the ongoing actors' strike right now. We've heard reporting about streaming platforms like Netflix possibly looking to raise prices in the coming weeks and months in response to higher costs associated with media. Do you think that Disney is more or less affected than other media companies with regard to the increasing costs associated with media generation and streaming as a distribution platform?
I think when we talk about cost, we have to think about cost in the context of revenue and ARPU. And given the newly increased prices that's coming online, the cost actually makes. We don't believe it's going to be an additional cost to Disney. In fact, the cost will probably help a little bit this year, but likely to normalize going onward starting in 2024.